Hey everyone. So, in this episode, we're going to talk about 4 rules that used to be mortgage rules that you can change and break in this climate that we're in right now. So, and when we say rules, we're really just saying things that weren't generally done when you had an average normal market. We're not in a normal market right now. So, in our climate, as many of you know, obviously this is area specific, but we are seeing a severe lack of inventory, and the inventory that's out there, a lot of them are still sitting on the market. So we say sellers aren't selling. We are saying buyers aren't buying because of, the perceived interest rate market being high, which it really isn't. In previous episodes, I do not think they are high. They're high compared to what they were, which was an artificially deflated rate for years and years. So what we're in right now is basically a wait and see approach. Many sellers are taking a wait and see. Many buyers are taking a wait and see, and they want to see what happens next before they do things as far as entering the market to sell or purchasing a property. So these were 4 rules that I saw. I actually saw this article. It's like, this is insane because the article is very accurate. So 4 rules. I'm going to put, I was on realtor.com. 4 beloved mortgage rules home buyers should break right now. And I couldn't agree more with these. So let's go over them one at a time. So the first one is, and many of you will understand this, is you should only get a 30-year mortgage. That is completely false. And different mortgages will serve people at different in different ways. So the 30-year mortgage is basically your benchmark. Most buyers and most people refinancing will refinance into a 30-year fixed, and if you're buying a property, they will finance a 30-year fixed property, 30-year fixed mortgage to buy that property. So there are different types of mortgages and terms to those mortgages that you can do. So, and I've even seen, I can't believe I'm even seeing this, but I've seen lenders offer out a 40-year mortgage. Can you imagine that, Nicole? Taking out a loan for 40 years. Like, if you're 25, you're not paying that thing off until is it 65, 40? That's insane. It's like your whole life you're paying a mortgage. And the difference in a payment between a 30 and a 40 is not that much. It's not a huge difference, but they're offering it out. Why? Because they feel buyers aren't purchasing property because rates are so high. So they're going to amortize it out longer to get that payment lower. It's crazy. 40 years. Would you take out a 40-year mortgage?
Nope.
Me neither. Well, I shouldn't say that. Let me rephrase that. If that was the only, if that was the only way I could get into the property because I'm buying it, let's say there's 20 or 30% equity that I'm buying.
Well, yeah, I take it back too. You know why? Because I could pay it off early.
You could. It's a great
So,
point. Did you know New Jersey does not have a prepayment penalty on residential mortgages?
do most states?
Some do. Yeah. New Jersey does not. So that's a great point. You can pay it off early. So what you could do, and here's what I used to advise clients that have children that are refinancing, and they're doing like a cash out, or they're just refinancing a rate term. Well, not really rate term, but if they're refinancing for cash out, they didn't want to. So if you say you own a home and you've paid in 5 years of it, and now you're going to refinance because you need some cash out. Instead of starting out at another 30, so the 5 years you paid is now gone to nowhere. You're starting over again. You can refinance into a 20 or even a 15, but because you're condensing that time frame into a smaller period instead of a 30, the payment's going to be higher. So it goes to what you just said. You can refinance and put it into a 30, but get the 20-year AM schedule or the 15-year amortization schedule and pay that payment. Know what it is. Say on a 30-year, your payment's $1,500, but on a 20-year, it's $1,800, and on a 15-year, it's $2,000. Well, pay one of those, and then most of the time when people have children, money gets tight 2 times a year. Back to school and Christmas. So what we tend to see with payment schedules is those months they'll pay the regular payment because money's a little tighter. But it goes to what you said, you can prepay and pay that 20 or 15-year schedule even though your loan is on a 30. So that's a great point. Good call. So let's go over real quick. ARMs tend to, and I took some notes here, ARMs tend to have lower rates than fixed 15, 20, 30-year, and even 40-year fixed rate loans. Let's say, for example, you take a 10-year ARM. If you're going to sell the property in less than 10 years, ARMs will give you a lower rate and a lower payment. They just will. Is there a risk with an ARM? Yes. But the risk is completely mitigated and gone if you sell the property prior to the loan adjusting. So that's why they serve a purpose. So base your decision on whether you're going to take a 3-year, 5-year, 7-year, or 10-year ARM on how long you estimate owning the property. Most investors that know they're only going to hold a property for 10 years or less will take an ARM rate because it gives you lower rate, lower payment. You'll have higher cash flow on that investment. So they're great for investment properties, fix and flips, and also a shorter term owner occupied. If you're going to move into a place and you know you're only going to stay there, again, less than 10 years, even less than 5, less than 7, an ARM might be a good idea for you. Again, there is risk if you end up taking and keeping the property longer than that. There's a risk with it because the ARM will adjust and you have to be prepared for what it adjusts for. But if you know you're going to be selling it prior to that adjustment, then an ARM would probably be a lower rate, lower payment. So let's talk about how ARMs work. Okay. All right. Because they get a bad rap. An ARM works, you have two things. So an ARM, you get your ARM payment from your index plus your margin. Okay. So index plus margin equals what you'll hear this term a lot, a fully indexed rate. Okay. So the index is what your adjustable rate mortgage is tied to. So it's going to be tied to something. So your general average indexes are the LIBOR, LIBOR, which is a London Interbank offered rate. So LIBOR, LIBOR. A lot of ARMs that I've seen over the last 10 to 15 years tie to that index, the LIBOR rate. Okay. Right now, that LIBOR rate is 5.07%. That's as of, I believe it was like June 1st. You also can tie it to the 1-year, the 3-year, or the 5-year T-bill, but I believe the 1-year T-bill is the most popular. T-bill being Treasury bill, United States. That's 5.158% right now. You can also tie it to the COFI rate, COFI, and that's the cost of funds index. The COFI rate is 0.232% right now. For car loans and HELOCs, home equity lines of credit, loans like that, it is tied to the prime rate. So you'll hear the term prime plus. So prime right now is 8.25. Yeah, I'll say that again. Prime is 8.25%. It was not that long ago. Prime was in the 2s. So it's at 8.25 right now. So those are your indexes. So you'll have your ARMs are going to be tied to usually one of those 4, depending on what loan you're taking out. Then they're going to take that index and add on a margin, okay? So the margin is the number of percentage points that a lender adds to the index to determine your fully indexed rate. And these will be lender specific. So I would always advise you to shop around a bit. See which lenders will give you the best index plus margin and what that index is tied to. That's important. So if they're going to give you an ARM and they say, well, Dan, this ARM's, the index on this one's the 1-year T-bill. Research the 1-year T-bill over the last, I'd say, 12 to 24 months. It's going to give you a good idea. I even would say even longer than that. Go back pre-COVID and see how that index was trending. Was it aggressively up? Was it aggressively down? And see how that was. And then compare that to like a LIBOR rate and see how the LIBOR was as far as, trending up, trending down. Shop these rates and see what they're going to be tied to. Different lenders will, add different margins. So maybe one lender A, puts a 1% margin on. So, for example, if it's a 1% margin and you're tied to the LIBOR rate, that's a 5.07% plus 1. Your fully indexed rate on that arm would be 6.07, which right now is less than the 30-year fixed, I believe. So that's how you determine a fully indexed rate. Each lender, again, will add, their own margin to the adjustable rate mortgage. Shop that around. A lender may put 3/4 of a point. Another lender may put 1.5 points. All depending. It's all lender specific. Okay. So do your own shopping and find out, who's going to give the best arm rates. So those are number one. So that's the number one, is you should only get a 30-year mortgage, 30-year fixed mortgage. Okay. The second mortgage rule that is not a rule you really shouldn't follow, or not that you shouldn't follow, that you can break in this climate is, and this is an important one, because I have a family member who said this to me, and I explained to them that that's not necessarily true. You should only have, you have to have a 20% down payment. Okay. And the reason you have to have a 20% down payment is you get the best rates and you're going to avoid MI, which is mortgage insurance, PMI, private mortgage insurance. So in the, previously, years back, we used to do that. We used to say to people, well, you can avoid PMI if you have a 20% down payment. That's not necessarily the case anymore. But let's talk about real PMI real quick. What is PMI? Private mortgage insurance. So we all know the term. We've heard it 100 times, but what is it? It's really lender's insurance. It's insurance that the lender is charging because you're putting down less than 20%. So anytime you put down less than 20%, a lender's going to deem you a higher risk. So when you do that, they're going to charge you insurance. And it's payable to the lender when the loan is taken out, and has lending. I can say less than a 20% down payment, or the LTV, which is your loan to value, the loan versus value of the property, is higher than 80%. Okay, 20% down payment puts you at 80% LTV. Okay, so right now there are many programs, I've seen them out there from different lenders, that you can put down 5 to 10%, and there's no MI, there's no PMI. Now you have to have really good credentials as far as, I believe, credit and income. But some of them, it's less than 20, and you don't have private mortgage insurance. So that whole 20% down payment theory of, well, I'm going to do it to avoid MI, it's not accurate in this market, because these lenders are getting very creative with the programs that they're offering. Most of them are to first-time home buyers. So I want to preface that. If you're buying a property and you've already bought numerous ones, sometimes this doesn't, it's all lender specific. But this 20%, MI might not apply to you because you've already purchased property before. There's a lot of programs the government offers for first-time home buyers to get you into a home. And this is one of them. Less than 20% down, no MI. Okay? So with these, and again, this is a good point, I wrote it down. With these programs, you can keep your money more liquid and possibly purchase another property with it. So instead of putting 20% down and you're buying, say your 20% down is $120,000. You can cut that in half, put down 10%, keep the 60, and then purchase another property with the 60. Totally doable. Totally doable. So that's another one. And again, this is only over these last few years, I'd say probably 4 to 5 years, that these lenders are now coming out with different programs where they're paying some of your closing costs, and the mortgage insurance, there is no mortgage insurance if you're doing less than 20. So keep that in mind. I've seen one, I forgot who it was. It was like 5% down and there was no MI. And I'm not sure your credit score, what your credit needed to be at as far as your FICO, and how much assets you had in the bank, or I think it was your income level. Your income had to be a very, very low risk. but they have them out there. So if you fall into those categories and you're thinking, hey, I want to keep more money, my money, instead of putting it into a down payment, you can do that. So that's number 2. This episode is brought to you by the Elite Builders. It's brokered by eXp Realty. I've spoken a lot about Elite Builders and the value stack that you get just by partnering with us. Aside from the financial value, which we'll get into in a minute, becoming an Elite Builder, really, you're going to basically change your life in every facet: physically, emotionally, mentally, spiritually, and financially. You're going to be in proximity to people that operate on a high level, high character, high integrity. We're creators, and what do we want to create? We really want to create leaders and inspire you and others to be the best versions of yourself, highest version of yourself that you can be. And then when you want to talk about it from a financial perspective, as far as if you're an agent or a broker, the value stack that you get free group coaching. All right, so let's go through them. Group coaching, it's a $3,000 value. You have role play groups that I run 2 of them, 7:30 and 11:30. Where you learn scripts on what to say, how to say it, and how to say it with confidence so you can help serve your clients to the absolute highest level. That's a $1,000 value. There's an exclusive ladies mastermind group. Okay, that's a $3,000 value. Very, very high these women are operating at such a high level, and they have their own exclusive mastermind. Awesome women in there. That's a $3,000 value. The scripts and the courses themselves that you get that and the courses that are online in like 40 different languages. That's a $1,000 value. The systems training, the CRM training that you get, the systems training itself is a $2,000 value. So we train you on how to put systems in place so you're operating your business at the highest level possible. So we have that. The CRM training, which is basically your database, we teach you how to put all of your clients into a database, and then it serves you and feeds you as far as contacting them, how often, and how to serve them. So it's basically where you're housing your whole business. That's a $1,000 value, and then the events and the webinars that we have, another $1,000 value. Like, you're looking at over $10,000 in value that other agents that aren't partnered with eXp pay. And when you do partner with us, these are all free. They're literally all free. So if this is of interest to you, just reach out to me. Again, you can subscribe to the channel, Dan the Man Talks Real Estate. I'll send you more information about it, or you can reach out to me on the other platforms, TikTok, Instagram, Facebook at Daniel Mesrobian, and we'll send you all the information you need to get you started on, again, just building your life and partnering with us to be literally the best version of yourself that you can. So that's the second. The third that we're going to go over now is you should not ask a seller to pay closing costs. And in a seller's market, this is not a recommended practice, okay? But with higher mortgage rates, we have less buyers, more properties that are falling out of contract right now from buyers pulling out. Properties tend to stay on the market longer now, and we're seeing that with the numbers that we've gone over in previous episodes. So as a seller, why not offer to pay a portion of the closing costs for the buyer? Because you know that they're going to, if they're financing property, if it's a cash deal, obviously this doesn't apply. But if they're financing, why not offer to pay, 10 grand of their closing costs or, 15 grand of their closing costs? It may be more important, that actually may be more important to a certain buyer than a price reduction or a reduced price. Maybe you just taking care of their, part of their closing costs, or all of them if they're not if it's not an aggressive number. So that's another one that as a seller, you can get a little creative with. Maybe in the listing, in the agent comments, you can put seller willing to pay $15,000 to closing costs, to buyer closing costs. That's a big incentive to a buyer to have a seller say, I'm going to pay your closing costs. That's a big deal because it's less money out of the buyer's pocket, and a very creative way for a seller to unload a property that he might be having problems selling traditionally. So it's another idea. So you, as a seller, if you're okay with that, instead of taking a price reduction, offer to pay the buyers, 15 grand in their closing costs, or however much you feel comfortable doing. It's a great strategy. The fourth that we're going to go over is don't pay points to buy down your interest rate as a buyer. Now, I don't recommend this if this is you're purchasing the property and you're going to do it for a short amount of time. You're only going to own it for, let's say 5 years or less. Okay, because there's a formula that calculates how long you need to own the home to recoup the cost of that point or two you're going to buy. Okay, so there's, it goes out. So it may be you have to own the home and pay in 7.5 years to recover that, that percentage point that you bought to get that rate down a full percent or however much it's going to come down. There's that formula. It's that break even. We call it a quote unquote break even formula. And because you're going to pay a point or two or however, or half a point or a point and a half, however many you buy. If you buy the interest rate down a full percent, let's say, for example, then you may be purchasing a full point. You're buying a point. Okay. And that point is 1% of your loan amount. So for loan amount, you're borrowing 400 grand, you're buying a point. That's $4,000 you're going to be paying. Now, this is also a good strategy. Again, it's a good strategy. If you're just going to stay in this property and you're going to own it for 10, 15, 20, 30 years, this is your forever home. Great strategy because now you're getting an interest rate down. And the other part of that is that point is tax deductible. So you can write that off. So make sure you figure out, again, that formula before you think about buying down a point. So that is important. So, and again, that point is 100% tax deductible. So talk to your accountant if you're going to do this strategy. It's a good strategy if you're going to own the home 10 years, 15, 20, and beyond. Great strategy to do. So those are 4 rules, quote unquote, that weren't done in previous markets that I would, it's a great article that, they were saying, hey, these are rules that are 4 beloved rules homeowners should break. I think it's a good strategy. All of these are unconventional, but help either buyer or seller with either selling property or buying property. And at the end of the day, that's the name of the game. If you're a seller, you want to sell it for the highest amount possible in the quickest amount of time possible to get you to your next destination. As a buyer, you're looking to get it for the lowest amount possible, for the least amount of money as possible. So if you can do one of these strategies to achieve that goal, great stuff. So if you're a buyer or you're a seller, let's say you're a seller and you're thinking about selling your property, you want to get a real estimate of what you think, the market's going to bear realistically, what you can expect to receive on the open market, or you're a buyer thinking about purchasing a property and you're ready to go, got your, you've spoken to a lender, or maybe you haven't and you're just beginning the process. Reach out to me, send me a DM, and be more than happy to walk you through each process of either you're a seller or buyer, what needs to go and what we need to do as far as steps to get you to that next destination.